Please start, sir.
Okay, thank you. Uh, so, good afternoon, everyone. Welcome you all to this first session on corporate financial accounting, corporate financial reporting, rather, Paper-18. Now, this webinar or online classes are basically meant for giving you a brief preparation of the upcoming examination. However, as you all can understand, it is not possible to provide online lectures on each and every topic. Therefore, what we have decided that we will select a few topics which will be of more importance, for the upcoming examination, and will provide a brief overview of the topic as well as certain important question and answer for the examination will also be discussed. So if you just go through the syllabus of this corporate financial reporting, this paper, then you will identify that there are certain accounting standards in this basically there. There are other topics including this consolidated financial statement, the business combination, and a few emerging issues also are there. So what we have decided that we will be concentrating more on the topics which are of something new, which are to you, which was not introduced at the intermediate level, and which are of great significance, which are of more significance for the upcoming examination. So if you just can follow the previous year's examination questions of whatever be the syllabus currently syllabus of 2022 or 2016, then you will find that more questions are normally set from chapters like this consolidated financial statement, business combination, and obviously from accounting standards also certain questions are set in the examination. So what I have decided that I will be concentrating more on these issues, that is consolidation, business combination, and accounting standards. There are obviously other issues where other topics are there, but those topics they are relatively less important for the examination purpose, or not more questions come from that particular those particular topics. Keeping that in mind, for this online tutorial sessions or online webinar sessions, I will be taking some sessions on consolidated financial statement, business combinations, and if time permits, if our schedule permits, then also some topic of on Ind AS that I will be taking. So what I have decided that today our topic will be consolidated financial statement. Now this consolidated financial statement, perhaps this topic is not totally new to you, at least the concept is not totally new to you. At the undergraduate level, if you have already studied, or if uh, of any particular university, if you have studied, then you will find that under corporate accounting there is a chapter called holding company accounts. Basically this consolidated financial statement is relating to that holding company accounts. Okay. However, the chapter that we will be discussed, the topics that we will be discussed, they are based on the new set of accounting standard, not the old set of accounting standard. As you all know, we have two set of accounting standards. One is the old accounting standard known as accounting standards as per the company's 2021 accounting standards rules. On the other hand, there is a separate set of accounting standard which is known as company's Indian accounting standards 2015 rules. Now, basically at the undergraduate level in most of the universities, this topic holding company accounts or consolidation is mainly based on old accounting standard, and the accounting standard which covers this particular topic was AS 21. However, in corporate financial reporting paper number 18, whatever we have, they are based on Indian accounting standard, and there lies the importance of this topic to be understood or to be learned in a separate way, because AS 21, whatever methodology it follows for preparation of this consolidated financial statement, that is totally different from the methodology which has been adopted under Ind AS. Okay, so under Ind AS, how consolidated financial statements are prepared, how holding company along with its subsidiaries, associates, joint venture companies report their financial statements, that is covered under Consolidated Financial Statement, paper number 18. Okay, we are aiming to cover the topic in that way under the guidance of Ind AS. Okay, now just to go to that, just a minute. Yes, right. So let me start the discussion in this way. Just a minute. Yes. Right. Now let us first have a brief introduction of what consolidation is, because preparation of consolidated financial statements will first require you to understand what is consolidation, why consolidation is at all required, and then only we can have a clear understanding of what we should go for, why we should go for preparing the consolidated financial statement. Now, the term consolidation, if you go by the dictionary meaning, then you will find that consolidation or consolidate means to combine. Accordingly, when we use this term in accounting, then by consolidate we mean to combine assets, liabilities, and other financial items of two or more entities into a single one. In the context of this financial accounting, the term consolidation basically refers to the preparation of consolidated financial statements. Okay, so through consolidation, we are actually aiming to prepare consolidated financial statements, where the financial performance, that is the profit and loss, and financial state of affairs, that is the financial position of the parent body, parent organization, along with all its subsidiaries, and now the associates and jointly controlled companies also are reported under the umbrella of the parent company. So basically, by consolidation, we aim to prepare consolidated financial statement. Okay. Now, the formal definition goes like this. Consolidation is actually a process of aggregating the items of assets, liabilities, income, expenditure, and cash flows of multiple companies under the direct and indirect control of one entity, as well as companies which are the associates or co-venturer of the current entity. All the entities in a consolidated way will prepare their financial statement through this process of consolidation. Now, if we want to know what is the benefit of consolidation, why should we go for consolidation? Basically, when an organization, say the parent organization, it wants to expand its activities, then there are different alternative avenues. One avenue may be to acquire another organization and to merge that organization with its own self. This we know is called merger acquisition. However, in case of merger acquisition, the target company does not exist in future. Only the acquirer, it exists, not the previous company, that is the company which has been acquired. Similarly, in case of merger, two companies getting together, and in that case, the final company emerges as a new company and existing two companies goes into liquidation formally. As a result, this particular external reconstruction plan, which we call the acquisition or merger, requires one entity to go for liquidation and the other entity either to emerge or to become a bigger entity. However, if the organization, the parent body, does not want the other organization to acquire and merge with itself, but it wants the other organization to operate on its own independently, then the option that it executes is not the acquisition or merger, but to simply acquire the controlling interest of that other company. By controlling the other company's decision, this parent company is still available to expand its activity through those other organizations where it is acquiring the controlling interest. So basically, consolidation is mainly meant for this parent subsidiary relationship. There are other concepts like associate company and joint venture where also this consolidation will be required. Not even that, under Ind AS, when a company acquires the other company and merges itself, the first balance sheet, the first financial statement that it prepares, that is also called consolidation. So in that way, consolidation in a generic term, in form of a generic term, may mean the merging of or integrating the assets, liability, income, expenditure figure of more than one entities into a single one, which applies in case of merger acquisition for the first time when the acquisition is made, for a holding company, for a parent company which controls the other organization known as subsidiaries or associate company or joint company, joint controlling company, or in case of joint arrangements also, this consolidation is required. So how consolidation helps us? Now basically, through consolidation, we can have a complete overview of the organization, the main organization, and all its subsidiaries, associates, and jointly controlled companies. That complete overview is required because parent company is making an investment in the subsidiary or associate company or other joint venture, joint arrangements. So the investors of the parent company may want to know how this entire arrangement of making or forming a group has been successful. Okay, so that is why a complete overview may be required, which is provided through consolidation. Moreover, if suppose a company, say X Limited, is having 9 subsidiaries, okay, 9 companies in which the parent company is controlling, then basically for each and every company we have one balance sheet, one PL statement, one cash flow statement, and one statement showing changes in equity. That is 4 statements for each company. Altogether, parent company plus 9 subsidiaries, there are 10 companies and 40 financial statements are there. Now it is not possible for an investor to actually evaluate all those 40 financial statements in order to get a complete picture of the group as a whole. So if it is possible to integrate, to consolidate the figures of all the subsidiaries with that of the parent company, and to prepare one single statement of PL, one single balance sheet, one single cash flow statement, and one single statement showing changes on equity, that will help the investor to understand the complete overview in a better way with reduced paperwork. That much analysis, 40 financial statement, analyzing the 40 financial statement will no longer be required. In that way also consolidation helps. In some cases consolidation helps to simplify the entire group activities. For example, when we prepare the financial statement separately, then as holding company, the parent company, and the subsidiaries or associate companies, they are independent, then they may have certain intercompany transaction which they record in their balance sheet independently, financial statement, PL statement, cash flow statement, independently. However, when we merge them together and we want to provide a complete overview of the merged entity, of the consolidated entity, then basically this transactions become intercompany transaction. That is, parent company selling goods to the subsidiary and subsidiary purchasing goods from parent company. Both are recording the transaction separately, but when we are consolidating them, when we are making a group and want to prepare a complete financial statement, then basically the purchase of one company is equal to the sales of the other company. So when both of those are recorded, then there is a need for elimination of this intercompany transactions, because the transaction in that case for the merged entity, consolidated entity, will appear in 2 sides. Okay, through elimination at the time of consolidation, this elimination is done. So through elimination of this intercompany transaction, consolidation gives us a simplified view. Okay, and finally there are legal compliance requirement. In case of India, if we follow Companies Act 2013, then there is a clear mention that consolidation will be required for a company which is the parent company for consolidating its subsidiaries, associates, and jointly controlled companies. So for legal compliance also consolidation is required. So either to provide a complete overview, or to have a simplified transactions, or to reduce the paperwork, and finally for legal compliance, consolidation of financial statements will be required. Okay, now comes the question, if consolidation is required, then how the consolidation has to be done? For that, we need to follow the regulatory framework for consolidation in India. Okay, now if you follow the regulatory structure for companies in India, then you will find that in India, companies are mainly regulated by Companies Act 2013, along with different company account rules 2014 and accounting standards. As I have already mentioned, the accounting standards are of two types: old accounting standard known as accounting standards, while the new accounting standard known as the Indian accounting standard. In our discussion, we will focus on Indian accounting standard only. So therefore, for us, the consolidation, the regulatory framework of consolidation comprises of Companies Act 2013 along with Company Rule 2014 and Indian accounting standards. Different Indian accounting standards are relevant for consolidation. We will come to that. Now let us first see what regulatory requirement is there with respect to consolidation in the Companies Act 2013. Now, as per section 129(3), there where a company has one or more subsidiaries, it shall, in addition to standalone financial statement, prepare a consolidated financial statement of the company and of all the subsidiaries and associate companies in the same form and manner as its own, in accordance with applicable accounting standard. What does it mean? When there is a parent company which is having a number of subsidiaries, then that parent company need to prepare its own standalone financial statement, that is balance sheet, PL, cash flow statement, or statement showing changes on equity. But along with that standalone financial statement, that parent company has to prepare a separate set of consolidated financial statement, that is consolidated balance sheet, consolidated PL statement, consolidated cash flow statement, and consolidated statement showing changes on equity. By consolidating its own figures along with the financial figures of all its subsidiaries and associate companies taken together. So, as per Companies Act 2013, Section 129(3), consolidation is a legal compliance for holding companies or parent companies. Now, when the holding company will prepare the consolidated financial statement and produce the financial statement to its shareholders or stakeholders, along with the financial statement, consolidated financial statement, a separate statement, not financial statement, a separate statement should be attached. That statement will contain the main features, salient features of the financial statement of the subsidiary or subsidiaries, associate companies, and the form is not specified, the form which will be prescribed. So far, no such form has been prescribed. In that form, the company should present the salient features, most important information about the subsidiaries. Okay, so through consolidation, or at the time of consolidation, the parent company is providing to the shareholder the consolidated financial statements, its own standalone financial statement, and not a financial statement but a normal statement containing important information of all the subsidiaries and associate companies which has been considered while preparing the consolidated financial statement. Now we need to know two terms here: what is subsidiary company and what is associate company, because those two terms we have used here. Coming to subsidiary company, just if you can see, I have highlighted the portion. As per section 287 of the Companies Act, subsidiary company or subsidiary in relation to any other company, which is the holding company, means a company in which the holding company controls the composition of the board of directors or exercises or control more than half of the total voting power, not number of share, total voting power, either at its own or together with one or more of its subsidiary companies. That means, suppose we are talking about two companies, A Limited and B Limited. Now, A Limited can be called at the holding company and B Limited the subsidiary company if A Limited controls the composition of the board of directors of B Limited, or alternatively, A Limited procures more than 50% of the total voting power of this B Limited. Now, it may so happen that A Limited is holding, say, 40% of the voting power of B Limited, but another subsidiary of A Limited, say X Limited, is also there, who is holding another 20% of the voting power in B Limited. So A Limited, along with the subsidiary X Limited, together holds more than 50, that is 60% of the voting power of B Limited. So in that way also, A Limited, which is the ultimate parent company, will be considered as the parent company or holding company of B Limited also. So either you, on your sole basis, controlling the board of directors composition, or you, along with your other subsidiaries, are holding more than 50% of the voting power of another company, then that another company is the subsidiary company of yours. In that way, subsidiary company is defined. Then what is the associate company? Now, the associate company, I am highlighting it. Just a minute. Right. The associate company, as per section 2(6) of the Companies Act 2013, in relation to again that another company which we call the parent company, it means a company in which that other company, the parent company, has a significant influence, but which is not a subsidiary company of the company having such influence. And this associate company concept should also include a joint venture company. So what does it say? Suppose again I am having a company, there are two companies, A Limited and say Y Limited. Now A Limited will be called the parent company and Y Limited the associate company. If A Limited is having significant influence on Y Limited, but A Limited is not the holding company of Y Limited, that is, Y is not a subsidiary, I am not holding more than 50% of Y. Okay. So what does this significant influence means? Now, as explained in the Companies Act, significant influence means control of at least 20% of the total voting power, or control or of the participation in the business decision under an agreement. That is, when A Limited controls 20% or more of the voting power, but less than 50%, less or up to 50% rather. So 20% up to 50% of the voting power of Y Limited, or as per any agreement, A Limited is exercising some control over the business decision of Y Limited, then A Limited is said to be the parent company and Y Limited the associate company. Joint venture, what does it mean? Now, the expression joint venture means joint arrangement, whereby the parties that have the joint control of the arrangement have rights to the net asset of the arrangement. Suppose A Limited and B Limited have entered into a contract, a joint arrangement contract, and they have built up an entity in which A Limited and B Limited both are controlling. So if in that merged entity, or in that jointly controlled entity, the A Limited as well as B Limited, if they have what we can say, the right to the net asset of that arrangement, net asset of that new entity, then A Limited as well as B Limited will be said to be the parent company, and that company, that jointly arranged company, will be known as the joint venture. Okay, so we have come across three important concepts. First of all, there is a parent company, and for the purpose of consolidation, there may be three options. First of all, there may be a company which is my subsidiary, where I am having the controlling power of its board of directors, or I have acquired more than 50% of the voting right of that company. Then this is my subsidiary company with which I am to consolidate. Secondly, there may be an associate company in which I have significant influence, which means I have acquired 20% to 50% of the voting power of that company, or by virtue of an agreement, I can participate in the business decision of that entity. then the entity is my associate company and I have to consolidate with that associate company also. Third option is the joint venture, that is I along with another party had created a new entity in which we have joint control and I am uh, having the right to the net assets, net worth of that jointly arranged company. In that case also, for the jointly controlled company, which we call joint venture, we need to consolidate. So in these three alternative cases, consolidation is required. Consolidation with subsidiaries, consolidation with associate, consolidation with joint venture. However, for the examination purpose, mainly consolidation with subsidiary will be important, not the other two. However, possibility is still there, a remote possibility is still there that a joint venture or with an associate company consolidation is possible. So preparation of consolidated statement may be there. However, as I have already mentioned, for the examination purpose, consolidation with subsidiary will be of prime importance. So in our discussion also, we will mainly focus, at least in this class, consolidation with subsidiary company. And if time does not permit, in the next class when we will be having a class on CFR, I will continue this discussion on consolidation and try to cover that consolidation with associate also, while that will not be of that much important for the examination purpose, as I have mentioned repeatedly. So that was the consolidation required, consolidation related compliance requirement as per Companies Act 2013. Now let us come to accounting standard. While accounting standards also provide some consolidation requirement, and in India, the new set of accounting standard, which we call the Indian accounting standards, they have provided certain well organized structure for this consolidation purpose. Okay, as you can see, company's Indian accounting standard rule 2015 prescribes the following accounting standard, Indian accounting standards, that deal with the preparation of consolidated financial statement along with separate financial statement of group entities. That is relating to consolidation. These accounting standards are important. It starts with Ind AS 103 business combination, and the prime most important accounting standard for consolidation, which we will mostly follow, is Ind AS 110 consolidated financial statement. Along with that, for joint venture consolidation with joint ventures, we have 111, disclosure of interest in other entities 112, separate financial statement Ind AS 27, and investment in associate and joint venture Ind AS 28. So this provides the gamut of in consolidation related accounting standards, of which primarily our discussion today will be limited to these two accounting standards, business combination and consolidated financial statement. Now let us have a complete overview of this consolidation requirement through a flow chart. Okay. Now you can easily can identify. I have just a minute. Okay, I have shown this that when an organization, say A Limited, is having sole control of another organization, B Limited, by virtue of its controlling the composition of the board of director or holding more than 50% of the voting rights, then I am the holding company and my solely controlled company, the say B Limited, is the subsidiary company. So if you ask in a given situation whether I am having the sole control of the other company, if your answer is yes, then the other company is subsidiary. And in that case, consolidation will be required in two steps: on the date of acquisition and all further reporting dates. On the date of acquisition, consolidation will be done as per Ind AS 103, and all future reporting dates, consolidation will be done under Ind AS 110. Now, if your answer is no, that is, it is not under my sole control, then ask the question whether I have obtained the joint control of the organization. If it is yes, then find out the type of joint arrangement. If the joint arrangement is joint operation, there is a definition separately, then you need to follow Ind AS 111. And if it is a joint venture type, which I have already explained, then you follow Ind AS 28 or 111 for the purpose of consolidation. Now, if your answer to the question is no, that means the entity that I am talking about, it is not under my sole control, not the entity is being jointly controlled by me with another party, then ask whether I am having significant influence on that other company or not. By significant influence, we will mean that I am holding 20% to 50% of the voting right of the company, or by virtue of an agreement, I can participate in the business decision of that other company. If your answer is yes, then that other company is your associate company, and in that case, consolidation will be done as per Ind AS 28. The method is known as equity method. But here also, if your answer is no, that is you are not the sole, you are not controlling that company solely, you don't have any joint control on the company, even you don't have any significant influence on the other company, then that other company does not require any consolidation, and that is only my investment in a financial asset, and we need to follow Ind AS 109 for the purpose of accounting of the same. So in that way, consolidation requirement can be understood. Okay, we will mainly be considering this sole control situation, not the other areas. Now, if we want to prepare consolidated financial statement, then how many statements we need to prepare? Now, if you just refer to Ind AS 1, then Ind AS 1 says that Ind AS 1 is known as presentation of financial statement. It says that an entity needs to prepare the financial statements, including a balance sheet as of the end of the period, a statement of profit and loss for the period, a statement of changes in equity for the period, and a statement of cash flows for the period. Along with that, there will be notes comprising of a summary of significant accounting policies and comparative information, that is preceding year information. All these are part of the financial statement of any entity. When we will be preparing consolidated financial statement, then all these statements will be prepared based on the principle of consolidation. Accordingly, in case of consolidated financial statement, the statements to be prepared will be, first of all, a consolidated balance sheet as at the end of the period, a consolidated statement of profit and loss, a consolidated statement of changes in equity, a consolidated statement of cash flows, and all related notes and comparative information should also be there under the set of consolidated financial statement. Okay. However, for examination purpose, mainly preparation of this consolidated balance sheet will be of importance. Okay. Other financial statements, normally in the examination we do not set question on other financial statements, but financial mainly balance sheet, consolidated balance sheet preparation will be there. Okay. Now, let me skip this part. Theoretical, these are theoretical areas on consolidation. Just a minute, let me go to the next part. Yes. Consolidation procedure for subsidiaries. As I have already mentioned, for examination purpose, consolidation with subsidiaries will be important. So mainly we will be covering this consolidation procedure for subsidiaries. However, when we will be preparing this consolidation requirement, then just a minute, right? When we will be preparing this consolidation, consolidated financial statements, then basically there will be a two-phase approach, okay, two-step approach. First of all, consolidation will be required to be done on the date of acquisition, and then consolidation will be required to be done on all subsequent reporting dates. Okay, so accordingly, our discussion also will cover this entire consolidation of financial statement into these two steps or these two phases. There's consolidation on the date of acquisition and consolidated financial statement preparation on the date of acquisition, and preparation of consolidated financial statement on all subsequent reporting dates. Okay. Now, what does it say regarding consolidation? As per Ind AS 110, paragraph 20, consolidation of an investee. Investee means the company in which I have made the investment. Consolidation of an investee, which can be subsidiary in our case, shall begin from the date the investor obtains control of the investee and will cease when the investor loses control of the investee. That is the date from which I am able to control the other entity. On that date, consolidation will start, and consolidation will end when that particular entity is not under my control anymore. Okay. Thus, accounting for consolidation will start on the date of acquisition first, and the parent will need to prepare consolidated financial statement on the date of acquisition and for each of the subsequent reporting date on a quarterly basis or on annual basis. What will be done in consolidation? Like items of assets, liabilities, equity, income, expenses, and cash flows of the parent company shall be combined with that of the subsidiaries. That is, plant and machinery of the parent with plant and machinery of the subsidiary will be added together, and that will form the consolidated figure to be reported in that way. Now, the carrying amount of the parent's investment in each subsidiary and the parent's portion of equity of each subsidiary shall be offset against each other as per Ind AS 103. The offset shall result goodwill and in some rare cases gain on bargain purchase. That is, when you will be consolidating, the other company's balance sheet altogether will be merged with, consolidated with the parent company's balance sheet. In that case, the parent company's balance sheet, which includes original standalone balance sheet, which includes that investment in the subsidiary, will no longer be there, and the offset will result this taking all the investments, taking all the assets and liabilities and offsetting against the same, the investment may result into a goodwill or gain from bargain purchase. Okay, as the case may be, that will be recorded. Now, up to this, let us cover first, and accordingly, how on the date of acquisition consolidation is done, let us go for that portion. Now, on the date of acquisition, when holding company, suppose A Limited has acquired the controlling interest in B Limited as on say 1st April 2022. 1/4/2022, A Limited has acquired the controlling interest more than 50% share of B Limited. Suppose 80% has been acquired. So on 1/4/2022, that is on the date of acquisition, A Limited will first prepare its consolidated financial statement. Okay, that is on the date of acquisition, first consolidated financial statement will be prepared. One balance sheet, PL, etc., will be prepared. Now, this preparation of consolidated financial statement on the date of acquisition is guided by not Ind AS 110 but Ind AS 103, that is business combination. Okay, according to Ind AS 103, just a minute. According to Ind AS 103, a business combination is a transaction or other event in which an acquirer, in our example A Limited, obtains control of one or more businesses, in our case B Limited, which is my subsidiary, as I have acquired more than 50% of the voting power of that other company. Thus, it is strictly different from asset acquisition. In case of asset acquisition, say if I have acquired a number of assets of A Limited has acquired a number of assets from B Limited, that asset acquisition does not allow A Limited to actually run the entire business of B Limited. Only some assets have been acquired, the ownership of those group of assets have been acquired. But when A Limited is acquiring the controlling interest of the business of B Limited, then that business acquisition comes under Ind AS 103, and in that case consolidation is required. So acquiring a group of assets does not mean you need to go for consolidation. You simply add those assets with your own. You need not to prepare consolidated financial statement. But when you are acquiring the controlling interest of B Limited and thereby you are taking up the business or you are controlling the business of the other company B Limited, then consolidated financial statement will be required. For business, and this acquisition of business comes under the purview of business combination. It is called business combination. So for business combination, the control by one entity of another entity is sufficient, and both the entity may continue to exist. That is, B Limited will be an independent company, will continue its business. A Limited from time to time will prepare the consolidated financial statement to show the overall picture of the entire group. In other words, business combination shall include both merger acquisition, as I have already mentioned, where the acquiree company ceases to exist. If I acquire that other company, if I merge that other company with myself, then that other company will no longer be in existence and it will be merged with me. That is also a business combination, and that is also requiring consolidation on the date of acquisition. And at the same time, I am acquiring the controlling interest, only more than 50% of the voting right of the other company, of that acquiring company. Then also it is called business combination, and that will also be requiring the consolidation as per 103. The only difference is that in case of merger acquisition, on the date of acquisition, we require consolidation, and thereafter, since the other company does not exist, there is no further consolidation requirement on other reporting dates because the other company does not exist anymore. In case of holding subsidiary arrangement, on the date when we acquire the controlling interest of the subsidiary company, there will be one consolidation, one consolidated financial statement preparation will be there. And for all other subsequent reporting dates, because on these reporting dates also the parent and the subsidiary separately exist, there will be the requirement of preparation of the consolidated financial statement. Okay. In that case, the parent company may acquire 100% of the subsidiary company, which we'll call wholly owned subsidiary, or it may acquire less than 100% of the subsidiary company, but subsidiary company still exists. In those situations, consolidation will be required for all subsequent reporting dates. We will first know how on the date of acquisition consolidation is done, and as per 103, and then we will come to know how consolidation will be done as per 110 for all subsequent reporting dates. Okay. Now a business combination is accounted for applying acquisition method. Okay. That is, on the date of acquisition, when we will be preparing the consolidated financial statement with the subsidiary, we will apply acquisition method. This acquisition method has 5 steps. We will very briefly narrate the step and won't go into very detail because the type of question that will come, it will actually specifically will mention the controlling interest has been acquired, how the controlling interest has been acquired, who has been acquired, all will be mentioned. Okay, so that evaluation will no longer be required. That is why we will cover these steps very briefly and directly go into the numerical problem. Okay, so acquisition method says that we need to follow 5 steps. We need to first identify the acquirer. So in our case, between holding and subsidiary company, holding company is the acquirer, subsidiary company is the acquiree. Secondly, we need to identify the acquisition date. Obviously, the acquisition date will be the date on which the holding company first obtained the controlling interest of the subsidiary company. For example, suppose A Limited has purchased initially 30% of the shares of B Limited. By purchasing 30% share of B Limited, A Limited doesn't become is not becoming the parent company of B Limited, doesn't have the controlling interest. But suppose after 1 year, another 30% has been purchased, and 30 plus 30 makes 60%. So on this day, when I acquired the second lot of 30%, I become the parent company and the other company becomes my subsidiary company. So this second lot purchase day will be the date of acquisition as per 103 for consolidation purpose. Okay, so consolidation, the acquisition, for consolidation, the acquisition date will be the date on which the holding company acquires the controlling interest of the subsidiary company. That is considered as the acquisition date. That may be the first day if I acquire more than 50% on the very beginning, or it may be any subsequent day if I have purchased less than 50% first and then additional shares have been purchased further to get the control. So in that case, the second date on which I get the controlling interest, cumulative vote through cumulative voting power being more than 50% will become the acquisition date. The third step is to recognize, means to record and measure the identifiable net assets, identifiable assets acquired and liabilities assumed and non-controlling interest in the acquiree. What does it mean? On the date of acquisition, I now need to record, for the purpose of consolidation, I now need to record the assets, identifiable assets of the subsidiary company, identifiable liabilities of the subsidiary company, and if there is other parties also. For example, I have acquired 60% of the subsidiary company, so 40% shareholder is still there, which are called others. These others are known as non-controlling interest because they are holding some share but they are not controlling, so they are called non-controlling interest. So on the date of acquisition, while preparing the consolidation, we need to recognize, that is record through measure and record identifiable assets, identifiable liabilities, and non-controlling interest holders, if any. Then this point number C actually comes under the numerical area. Then recognizing and measurement of the goodwill or gain for bargain purchase, that has to be done. And finally, there will be disclosure. Now, the numerical portion will involve these two areas. That is recognizing and measuring the identifiable assets acquired and liabilities assumed and any non-controlling interest in the acquiree, and finally recognizing and measurement of the goodwill or gain from bargain purchase. Okay, so let us consider this two steps in detail now. Yes, this one. Now suppose, as per our example, A Limited, the holding company, has acquired the controlling interest of the subsidiary company B Limited on 1/4/2022. So on 1/4/2022, A Limited needs to prepare a consolidated balance sheet and all other consolidated financial statement. For this purpose, A Limited needs to identify, needs to record in the consolidated set of accounts what are the assets identifiable in case of with B Limited, what are the liabilities identifiable with B Limited, and what is the magnitude of other persons share other than me, other shareholders interest in the subsidiary company. Okay, now suppose if I have purchased 100% the shares of the B Limited, then there is no other persons involved, so no non-controlling interest will be there. But if I have acquired 60%, the others have still holding 40%, that these 40% shareholders, they will be known as non-controlling interest. We, on the date of acquisition, the holding company needs to value the assets that it gets from the subsidiary, that it gets the control over the subsidiary, the liabilities that the subsidiary holds. The holding company need to identify them and value them, and then record the same in the consolidated set of accounts, and also record the amount attributable to non-controlling interest. Now again, non-controlling interest are measured in two ways: fair value method and proportionate share of identifiable net asset method. These are the two methods that are followed for calculating the non-controlling interest amount. Okay. Next, once you have calculated the identifiable value of assets and identifiable value of liabilities, then assets minus liabilities, you can get the net assets. Okay. Now, the next step is recognizing and measurement of the goodwill. Now, goodwill is measured at the acquisition date as excess of 1/2. What is 1? 1 is the aggregate of fair value of consideration transferred. And if you have identified any non-controlling interest, then the amount of non-controlling interest recognized. Okay, these two taken together will be the aggregate, which we call number 1, step number 1. Third, let us omit first. We will discuss this third point later on. This is relating to lot purchase. Okay, so simply say, first we need to calculate a step 1, which will require us to get the aggregate of fair value of consideration transferred and the non-controlling interest value recognized. Then with this we need to compare the net assets recognized, that is fair value of assets minus fair value of liabilities. Okay. Now there are two possibilities. Either one can be greater than 2 or one can be less than 2. When we find that the aggregate of 1, that is step 1, is higher than step 2, what does it mean? It means the amount that I have paid and the amount the non-controlling interest holders have paid to get the control of the organization is higher than the net asset attributable to us. Okay, that is we have paid